So, I'm sitting in front of the computer creating an article by TheStreet.com's Chuck Marvin. The headline of which is, oil closes in on $100. And so, there's been a lot of talk about this, oil getting up to $100 a barrel. And the first couple of paragraphs of the article read as such: crude oil prices got the closest they've ever been to $100 a barrel in overnight trading before pulling back just a bit. Still, the century mark again appears to be on the verge of being crossed, especially if inventory data due out at 10:30 in the morning are bullish. In other words, if they come out and say they don't have enough inventory on hand. Crude for January delivery reached a high of $99.29 in electronic trading, but lately the near-term futures contract was up 38 cents from the last settlement of $98.41. On Tuesday, oil finished above $98 for the first time, ending it at $98.03. And a recent run has lifted crude oil after it retreated back toward $90 a barrel last week. Should the weekly numbers from the Energy Department later in the morning show tight supplies, $100 on the light sweet crude contract could become reality. Then it goes to talk about the other energy markets. So we've got people out there everywhere making a big deal about this, talking about oil prices and gasoline prices being at all-time highs. Well, it turns out all the hullabaloo may be for nothing. When you talk about oil prices, or any prices compared historically, you have to talk about inflation-adjusted prices. It's the only true measure of what the real price for something is. And so if you look at inflation-adjusted prices, obviously something that cost $1 in the 1970s and something that cost $1 today, that item was more expensive in the 70s because of inflation, because a dollar meant more, was worth more at that time. So we come to inflationdata.com. And if you haven't been to inflationdata.com, I recommend that everybody go there and read what they have to say about the oil prices and about the gasoline prices. But I'll just summarize here. If you look at the historical data for oil prices adjusted for inflation, the real high was in 1979. December 1979, oil averaged $100.28 in today's dollars for the entire month. In July of 2006, the monthly average for oil prices was $65.93. And this chart is not updated all the way, but we've seen highs, daily highs lately, between $90 and $99. However, for oil to match the price that it was in December of 1979, oil would have to go to $100.28 and stay there for an entire month to equal what was happening in real dollars in 1979. Of course, oil prices are closely connected with gasoline prices, and so an examination of gasoline prices would be in order also. And we look at the adjusted price for that, and in 1980, I believe these are annual averages. 1980, the average price of a gallon of gasoline, was just over $3. So gas would have to go to $3, stay there long enough to bring the yearly average up to those $3, and then maintain that level for a year for us to be in the same situation that we were in 1980. Right now we've gone over $3 and we come back to $2.50 and we go up to $3. It would have to go up to $3, go above $3 long enough to bring the average up to $3, then stay there for an entire year to equal what was going on in 1980. But let's look at it even further. And InflationData.com points out that if this were to happen, and eventually it probably will, oil will go to $100 a barrel and average that for a month. Gas may eventually average $3 for a year. If and when that happens, well, then we'll be able to say that prices are at all-time highs in inflation-adjusted dollars. But even then, the effect of these prices will not be as severe as it was in 1980. The average car today gets much better gas mileage than cars in 1979 and 1980 got. So if the price were to equal out in inflation-adjusted dollars, we still get more out of 1 gallon than we did back then. So we're having to buy less gallons. So the percentage of our budgets that we're spending on gas would still be less even if gas were to do what I said, go above $3 long enough to bring the average up to $3, then maintain that level for an entire year. Of course, if it were to do that, newspapers and financial reports would be going crazy about the price of gas. But even if it were to do that, it would represent a smaller portion of our income because the average American has to buy less gallons to fuel their car than they did back then. Another thing about it is that the average American has more money to keep in their pocket right now due to lower interest rates and inflation rates. Inflation in 1979 was something like 13 and 14%. The percentages of interest that we were paying on our mortgages were 13 and 14. I remember my parents financed a house, and I believe even 1987, and they had excellent credit. I think they financed that thing at 11 or 12%. And with my horrible credit today, I have a finance below 10%. So if it were to go and become equal, we'd still be paying less as a percentage of our income because we got less gallons, because cars are more efficient. If it were to go high enough to compensate for the new efficiency of the newer cars, which would make it have to be something like $4 a gallon, we would still have more household income available than we did back then. Not more than we did, say, in 1995 or in 2000, but more than we did at the all-time highs because of inflation and lower interest rates. Tax rates are also significantly lower than they were at that time, leaving the average American family with more money to spend for household needs. So if that is what prices are, they're nowhere near what we should call record levels, and they're certainly not about to crash the economy anytime soon. In fact, Americans still with these prices have more money for disposable income, on average, than we did at the time of these real all-time highs back in 1979 and 1980.